Welcome back to the Daily Crypto Roundup, where we break down exactly what is moving the crypto market today, what's noise, what actually matters, and what the smart money appears to be doing behind the scenes. Overnight, we saw a sharp crypto rout that shook confidence across the board. Bitcoin plunged into the mid-$64,000 range before snapping back above $66,000. Institutional buyers quietly added to their positions. A billionaire doubled down publicly on his Bitcoin conviction. And one of the largest corporate holders of Ethereum added nearly $100 million worth of Ether, despite sitting on more than $8 billion in unrealized losses. That's the backdrop. Volatility, fear, conviction, and capital deployment all colliding in the same 24-hour window. Right. Here are the latest top 10 cryptocurrencies by market cap excluding stablecoins. And this price update is sponsored by Kraken. It's who we use and trust for buying and trading crypto. And if you want to support the show, you can use the link in the description below. Bitcoin is currently trading at $66,177. Ethereum is at $1,904. XRP is at $1.38. Binance Coin is at $607. Solana is trading at $79.93. Tron is at 28 cents. Dogecoin is sitting at 9 cents. Bitcoin Cash is at $534. Cardano is trading at 27 cents. And Chainlink is at $8.45. Those are the live market leaders right now, excluding stablecoins. And as always, prices are moving fast in this volatility environment, so keep an eye on those key levels as we head into the next session. Overnight during Asian trading hours, Bitcoin sold off aggressively, sliding from above $66,000 to the mid-$64,000 range in a relatively thin liquidity window. These are the hours where order books are lighter, which means price moves can accelerate quickly when sell pressure hits. The trigger was not crypto-specific, it was macro. Markets reacted to renewed global trade tension and tariff developments that introduced fresh uncertainty into risk assets. When global policy shocks hit, large portfolio managers reduce exposure to anything perceived as volatile or speculative. Crypto still sits in that risk bucket. So what we saw was a classic de-risking move. Bitcoin fell. Ethereum followed. Altcoins dropped harder. Liquidations accelerated the downside. Bitcoin did not collapse through support and cascade into a panic. Instead, buyers stepped in around the $64,000 to $65,000 region, and price rebounded above $66,000 as European and US markets opened. That bounce matters, not because it guarantees upside, but because it shows there is still capital willing to defend key levels. This kind of price action tells us we are in a volatility regime, not a trend regime. In a trend regime, price moves smoothly in one direction. In a volatility regime, price whipsaws as opposing forces battle for control. That's exactly what we are seeing right now. Zooming out slightly, Bitcoin is now down roughly 25% from its recent highs earlier in the year. That's not a minor pullback. That's a meaningful correction. But it's also not historically abnormal for Bitcoin. The question isn't whether volatility exists. It's whether the structure underneath the market is deteriorating or being accumulated. That brings us to our second major story, Strategy. The corporate giant known for its aggressive Bitcoin treasury strategy just announced its 100th Bitcoin purchase. Let that sink in. 100 separate purchase announcements. This latest buy added 592 Bitcoin to its balance sheet, worth roughly $39.8 million at the time of purchase. The company now holds approximately 717,722 Bitcoin in total. That is a staggering number. At current prices, that's over $47 billion worth of Bitcoin sitting on one corporate balance sheet. The cumulative purchase cost across all acquisitions is estimated above $54 billion. Strategy is not buying tops. It is buying consistently. It buys during rallies. It buys during dips. It buys during fear. That consistency signals long-term conviction rather than short-term speculation. Institutional accumulation during volatility is fundamentally different from retail dip buying. Institutions operate on multi-year time horizons. They do not need next week's candle to be green. They care about 5-year supply dynamics, monetary policy cycles, and structural adoption trends. Every time strategy buys, it removes Bitcoin from circulating supply. It tightens available float. It reduces coins available for sale on exchanges. That doesn't automatically pump the price, but it builds a supply-side foundation that can matter later. And here's the nuance. Institutional accumulation does not prevent drawdowns. It doesn't stop volatility. But it does change long-term equilibrium levels. When supply is progressively absorbed by high-conviction holders, sharp downside moves eventually run into thinner available inventory. That's not bullish hype. That's simple supply math. Now let's layer in the third story. Ricardo Salinas, the Mexican billionaire entrepreneur, publicly reiterated his bullish stance on Bitcoin after the recent plunge. He did not hedge his words. He did not soften his tone. He said this is an opportunity. Salinas has historically disclosed that a significant portion of his liquid portfolio is allocated to Bitcoin, at times reportedly as high as 60 to 70%. That is an extraordinary allocation for someone of his net worth. When someone operating at that level doubles down publicly during volatility, it sends a message. Not necessarily a trading signal, but a confidence signal. We need to separate two things here. Public conviction does not move price immediately. Markets are too large and too complex for that. But conviction from high-profile figures influences sentiment over time. It shapes narratives. It reinforces long-term theses. Salinas frames Bitcoin as protection against monetary debasement. He sees it as digital hard money. That perspective aligns with Bitcoin's core supply narrative. Fixed issuance, halving cycles, resistance to inflationary manipulation. But we also need realism. Billionaires can withstand volatility far better than average investors. A 25% drawdown for them is not existential. For over-leveraged traders, it is catastrophic. So his conviction operates within a capital structure that can tolerate pain. Still, the broader point stands. We have one of the world's wealthiest individuals publicly buying dips, while macro headlines scream uncertainty. That tension is important. Now let's shift to Ethereum and the fourth major story. BitMine Immersion Technologies added approximately $98 million worth of Ether last week, increasing its already enormous Ethereum holdings. At the same time, reports estimate that its total Ether position is sitting on more than $8 billion in unrealized losses due to price declines from earlier purchase levels. This is where institutional risk tolerance becomes visible. BitMine is not trading short-term volatility. It is accumulating Ether as a treasury asset. It is accepting massive paper drawdowns in exchange for long-term positioning. Unrealized losses do not equal realized losses. As long as the company does not sell, those losses are accounting entries, not cash exits. But they do represent mark-to-market pressure. The critical insight here is this. Large institutions are still deploying capital into Ethereum despite sitting on billions in drawdowns. That suggests they do not view current price weakness as structural failure. They view it as cyclical. Ethereum, like Bitcoin, remains highly sensitive to macro risk. But it also benefits from staking mechanics, network revenue, and ecosystem activity that differentiate it from purely speculative tokens. When we step back and connect these four stories, a pattern emerges. Short-term price action is being driven by macro uncertainty. Long-term positioning is being driven by accumulation. That divergence creates volatility. On one side, traders are de-risking because of tariffs, geopolitical tension, and global economic questions. On the other side, institutions and high-conviction individuals are adding to positions. This is what transitional markets look like. They are messy, they are uncomfortable, they are noisy. If we were in a full capitulation phase, we would expect to see institutional selling, corporate balance sheet trimming, and public figures distancing themselves from crypto exposure. That is not what we are seeing. Instead, we are seeing buying. That does not mean the bottom is in. It does not mean price cannot go lower. But it does mean the structural thesis remains intact among capital allocators with long-time horizons. Bitcoin breaking below $65,000 overnight shows that liquidity pockets remain fragile. If macro headlines escalate, further downside cannot be ruled out. Support levels can fail under sufficient pressure. However, the bounce back above $66,000 demonstrates demand still exists. We are not in free fall. We are in conflict. Ethereum's position is similar. Price weakness has exposed holders to significant unrealized losses, but capital continues to flow into the asset. That suggests belief in its long-term role in decentralized finance and smart contract infrastructure remains strong. Altcoins are where the pressure is most visible. When Bitcoin drops, altcoins drop more. That's leverage at work. That's risk compression. The key metric to watch over the coming sessions will be whether Bitcoin can hold above that mid-$65,000 region on closing timeframes. If it does, we likely enter consolidation. If it loses that region decisively, volatility expands. But again, zoom out. Supply is being absorbed by long-term players. Corporate treasuries are adding Bitcoin. Institutional entities are adding Ether. Billionaires are publicly doubling down. Short-term volatility is clashing with long-term conviction. This is not the first time crypto has faced macro-driven pressure. It will not be the last. The asset class is still maturing. Correlations with equities remain elevated during global uncertainty. The bigger question is this: does macro instability strengthen or weaken the long-term Bitcoin thesis? If global trade tensions persist, if fiat systems face renewed inflationary pressures, if monetary policy shifts unpredictably, then the narrative of a non-sovereign fixed supply asset gains conceptual strength. But narratives take time to translate into price. Right now, we are in the in-between phase. Volatility is high. Liquidity is thin. Sentiment is cautious. Yet accumulation continues. As always, risk management matters more than prediction. Over-leveraged positioning in environments like this gets punished quickly. Patience and discipline tend to outperform emotion. We will continue monitoring whether institutional buying accelerates or slows, whether corporate balance sheets expand crypto exposure further, and whether macro conditions stabilize or intensify. For now, the signal is mixed but not broken. Short-term turbulence, long-term conviction. That's your market. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.